September is historically a tough month for US stocks, and it's no different this year. The S&P had its worst start to the month in over 70 years, and mixed US jobs data didn't help dispel fears about the state of the US economy. With the global sell-off on August 5th still top of mind and more volatility expected ahead, what should investors be on the lookout for?
A market correction is usually a pullback of 10% from its high and is usually considered as a healthy pullback from a bull market. A bear market is usually more severe. So for example, during a market downturn, right, a bear market signifies like a more than 20% drop in the recent high.
So how do you know if a bear market is brewing?
There are different types of bear markets. The most recent ones have been in 2022 and March 2020, and both of them, particularly the one in March 2020, was very short-lived. So it's very hard for us to, at this current juncture, determine whether a pullback is a correction, a short-term bear market or a long-term bear market. What to look out for is really the growth outlook of the economy and as well as the companies in the industry. So as an example, if you were to buy a very nice handbag and the prices dropped, you would think this is a great opportunity. I think it's very similar in the market. What's important is not the price, it's the quality of the bag or the quality of the company. So if you focus on the company's fundamentals and the earnings, the prices coming down is an opportunity, right? So that's why it's very hard to know whether it's a correction or bear market, but what's important is for us to focus on the fundamentals of the economy and the company.
Some people focus on macroeconomic indicators, they look at the jobs, they look at GDP growth, or they may look at some more forward-looking kind of economic indicators. Some may look at, from a fundamental perspective, look at the valuation of the companies. So if they're overly valued, that means there is a higher chance that the market may correct or crash. And lastly, some may adopt technical analysis. For example, 200-day moving average, if the prices fall below that, then they deem it as a bear market. So there can be many definitions, many indicators, and one thing to know is that none of these indicators are 100%.
Market rallies or bull runs may take longer to peak, but bear markets can happen much quicker.
There's a saying that they say bulls go up the stairs and the bears jump down the windows. So generally it is true that the bull market is a lot longer. It can last for 5 years, 7 years, or even 10 years for a bull market to go on. But whereas a bear market typically happens very fast, right? The fear usually creates a lot more selling forces and cause the share price to plunge very quickly.
Depending on the situation, interest rates are used either as a policy or sometimes as a causation for economies to grow and slow. In 2022, for example, because coming out of COVID, there was an imbalance in supply and demand, we saw inflation move higher, and because of that, the Fed had to raise interest rates. And in turn, that slows down the economy, right? So interest rates plays a part in triggering a bear market. But also, there are Fed policy moves to actually stop a bear market from happening. So for example, in March 2020, the Fed would aggressively jump in to cut rates.
Bear markets are typically represented by the S&P 500 index, which has seen 12 bear markets since it launched in 1957. That's one market crash happening every 5.5 years. In recent years, the bear markets in 2000, 2007, and 2020 coincided with economic recessions. In particular, the S&P fell 51.9% during the subprime mortgage crisis from 2007 to 2009. But the market recovery was also massive.
After the great financial crisis in 2008, we saw a 400% increase. From the pandemic in 2020, the rebound was about more than 100%. It is a tough period for investors, and it is the tough investors that stick to their investments and continue to grow their investments portfolio.
So how should you invest in a falling market?
Don't panic sell, because that's one of the key mistakes that people do once they see the market start to move against them. You should always evaluate your risk tolerance, because a pullback, you never know, you can be down 50% at one moment and 80% at one moment, right? That's why dollar cost averaging is very important. Maybe enter at every 5% drop. We don't know when is the bottom, but then at least we are getting it at a discounted price.
I would remain cash if the market turns bearish. But for the longer term investment, I will just hold them unless fundamentally they are weakened and deteriorated too much, and I may just sell them. But if they are, their fundamentals remain strong, I may even buy more, right, that at a lower price if the market gives me the opportunity to do so.
For the average investor, adopting aggressive trading strategies can lead to less than good outcomes. It's our advice that you have a well-diversified portfolio of different types of strategies in there. I mean, you could have tilts, but again, the advice is not to have the tilts in too much concentration, because the market moves faster than you think, and it's very difficult for an individual to outpace the market in that way.
Technology stocks, which have fueled the bull run, typically become more volatile during market downturns. So, investors tend to shift to defensive plays.
Well, I will probably look into consumer staples. I'll look into healthcare, utilities, because they tend to hold their value well during a recessionary environment. I'll actually go into the fundamentals, looking at their price to earning ratio, their discounted price to book ratio. If they have a strong cash flow and low debt, you can actually consider safe haven assets like your gold or even bonds. T-bills, for example, is the risk-free interest rates that people usually go for.
Definitely, if you want to buy individual securities, there will be some more due diligence to be done as opposed to someone who just buy, let's say, an index fund, right? And I think that's perfectly fine because you just passively track the market returns, and the market returns have been fantastic.
While it's difficult to predict what will happen next, investors shouldn't fret if they have a long-term perspective.
If they have actually set aside enough emergency fund for the next 6 to 12 months and they have set their time horizon right, there shouldn't be any emotions involved in investing.
People think bull markets are very different from bear markets because the market sentiment is much better, the outlook is better, the prices are moving higher. So people feel like geniuses when they're bull market, and people feel very down and bad about themselves in bear markets. But in reality, it's all part of one cycle or a big cycle. It's just a different part of the cycle and a different part of the price. And so your attitude shouldn't be too different between a bull or a bear market.